section that we're going to discuss today is on adjustments. It can be found in publication 4012, tab E. Adjustments are listed on the form 1040 on line 10. Those adjustments come from the Schedule 1, line 22. And you can see that on the form 1040 that's displayed. Part 2 of Schedule 1 lists the adjustments that we typically see. On line 10, you would see the Educator expense, and we'll go into these in more detail a little later on. 12 is Health Savings Account deduction. Line 14, deductible part of the self-employment tax. Also line 16, the self-employment health insurance deduction. 17, penalty on early withdrawal savings. Alimony paid on line 18A. And do note that there is a space to list the recipient's Social Security number on 18B. Line 19, IRA deduction. Line 20, student loan interest deduction. And line 21, tuition and fees deduction. These are the adjustments that we will discuss this afternoon. Publication 4012, page E1, shows you the screen in TaxSlayer that you will need to navigate through. And we've been talking about how to navigate through TaxSlayer earlier today. But you simply click on the adjustment, for instance, education expenses, then you click on the begin button and you would follow the prompts within TaxSlayer. But again, you can see the adjustments that are typically the ones that we will see from our taxpayers. Okay, the first adjustment that I want to talk about is the Educator expense. It can be found in publication 4012, page E4. The Educator expense, as I stated earlier, would be found on Schedule 1, line 10. This slide talks about the qualifications. What is the maximum benefit? $250 for a single taxpayer and $500 if both taxpayers could claim the educational expense. Who can claim the expense? Eligible educators, and they must either be a kindergarten through grade 12 teacher, or instructor, counselor, principal, or aide who worked in the school for at least 900 hours during a school year. Please pay special attention to the 900 hours during a school year. You will see this later. What are the qualifying expenses? And this information is listed here: books, computer, materials that were used in the classroom. Additionally, professional development expenses are allowed unless reimbursement is offered by the school but not accepted. What are non-qualifying expenses? And those are listed: homeschooling, non-athletic supplies. And these are some other issues that may apply, but we rarely see these. The next adjustment that we will talk about is the health savings account. The health savings account is a tax-exempt trust or custodial account that a taxpayer sets up with a qualified HSA trustee. And these distributions are non-taxable if the funds are used for qualified medical expenses. A taxpayer must be an eligible individual to qualify to contribute to an HSA. These are the qualifications: be covered by a high deductible plan on the first day of the month, not covered by other health insurance, not enrolled in Medicare. However, the months prior to being enrolled in Medicare could be used, and not be eligible to be claimed as a dependent on someone else's tax return. This is the form that you would typically see at our sites, and we don't see a whole lot of health savings accounts at our sites, but this is what the form would look like. You might have information in box 1, you may have information in box 2, box 6 may have some information checked. Of course, you would have the participant's name and the social security number and so forth, along with the address of the taxpayer. But you would need this form 5498 SA. Now, you might wonder, how will I know if the taxpayer has a health savings account? And page E-7 talks about how you can tell if a taxpayer has this issue. The interview or the intake form might have unsure or HSA box yes or unsure checked. Also, the form W-2 would contain a W in box 12. The taxpayer has a form 1099 SA with an X in the box showing distributions from an HSA. So these are some indicators that there is a health savings account issue. Okay, at any point, if you have questions, just put them in the chat. Okay, let's take a look at what the form would actually look like in TaxSlayer. It would be the form 8889, the health savings account. Okay, you would indicate whether it was the taxpayer's or if it was the spouse's HSA. Also, whether it's a family or an individual in the drop-down box. Also, you would have an amount under HSA contributions. And one thing that we might want to point out here is that the employee contributions are entered here, but the contributions can also come from relatives and friends and considered to be made by the taxpayer. But you would not include the employer's contribution on this line. Also, in the next box, the account holder needs to tell you how much was put in the HSA, because sometimes the form 5498 may not have all of the information for preparing the tax return. Now, you might wonder what are qualifying medical expenses. And in the publication 4012 E-8, it talks about what the qualifying medical expenses are. And it's generally expenses that can be deducted on the Schedule A, which is the itemized deduction form. And we'll talk about that a little later. But you might want to pay close attention to the CARES Act, because it made some modifications now, but this is only for years after December 31st, 2019. Menstrual care products are now reimbursable, and also over-the-counter products and medications are now reimbursable without a prescription. But again, you can find all this information in the 4012 on page E-8. Another adjustment that a taxpayer is entitled to is the self-employment tax. Self-employed taxpayers can deduct a portion of their self-employment tax from their income. But no worries, TaxSlayer, once the business income is entered, it will compute this automatically for the taxpayer. And this can be found on Schedule 1, line 14. Now also, self-employment health insurance for the self-employed individual can be deducted here, but generally that's been entered on the 1040C, so you can't take it twice. But that is entered on line 16 of the Schedule 1. And this is the form or the page in TaxSlayer that would address this. Okay, the next adjustment that we want to talk about is the penalty of early withdrawal of savings. That would be found on a Form 1099 INT, Box 2. There is a penalty for early withdrawal, and we will talk about that a little later on in the class. Okay, the penalty for early withdrawal would be found on Schedule 1, line 17. Okay, the next adjustment that we would like to discuss is alimony. We used to not see a lot of this in Texas because we used to say Texas does not have alimony. But with more and more people moving into Texas, we do see this to a small degree. But what the law says is that payments defined as alimony are deductible, but are deductible by the person making the payment. Payments, these are the qualifications. Payments are required by a divorce or separate maintenance instrument. Payer and recipient spouse don't file a joint return with each other. Payment is in cash or cash equivalent. Payments isn't designated in the instrument as not alimony. Spouses legally separated under a decree of divorce. Payments aren't required after death of the recipient. Payment isn't treated as support. Now, these payments are deductible by the payer, but they have to be included in income, which I'm sure you've already discussed, by the recipient. That's why you have on line 18B a place to enter the recipient's Social Security number. The next adjustment that we will talk about is the IRA deduction. And this is for traditional IRAs, not the Roth IRA. And these are the requirements. Taxpayers may be able to deduct some or all of their contributions to an IRA, depending on the circumstances. Generally, amounts in an IRA, including earnings and gains, are not taxed until distributed. Contributions may be eligible for the retirement savings contribution credit. This is the one place where you might see a double deduction, where you could deduct it as an adjustment and then get a credit. This rarely happens. Individuals must have taxable compensation, and contributions must be made by April 15th of 2021, although the tax year ends December 31st, 2020, but taxpayers have an additional 4 months to make that deposit into an IRA account and still be able to deduct it on the 2020 tax return. And last, the deduction is the lesser of contributions or compensation. So what that says is the maximum contributions, depending on age, if you're under 50, the maximum contribution is $6,000. If you are older, the maximum contribution is $7,000. But remember, it is the lesser of. So if the taxpayer was under 50 and they didn't make $6,000 in compensation, they would only be limited to the amount of compensation that they received. Okay. Another adjustment that the taxpayer is entitled to is the student loan interest. And this can be found in publication 4012, page E-11. And this page describes the maximum contribution and what the qualifications are. For example, the maximum benefit you can reduce is up to $2,500. Loan qualifications. It has to be a student loan, and taxpayer must be legally liable for the loan. It must have been taken out solely to pay educational expenses and can't be from a related person or made under a qualified employer plan. The student qualifications, it can be you, your spouse, or a person who was your dependent when you took out the loan, or would have been your dependent except for gross income or the merit filing jointly test. They must have been enrolled at least half-time in a program leading to a degree, certification, or other recognized educational credential. The time limit on the deduction. You can deduct this interest paid during the remaining period of your student loan. So until, if that's 20 years, you can still deduct that interest within the specification. And one caution is that there is a phase out. The amount of your deduction depends on your modified adjusted gross income and your filing status. So you might want to make a note of that as well. This slide shows the source document for the student loan interest, which is a 1098E. And of course, it would include the lender's name, the recipient's social security number, the borrower's name and address, and it also would include in box 1, student loan interest received by the lender. Okay, and the student loan interest would be found on Schedule 1, line 20. The next adjustment that we will discuss is tuition and fees. Taxpayers are allowed to deduct tuition and fees based on the following circumstances. What is the maximum benefit? Well, you can reduce your income subject to tax by up to $4,000. There is a phase out, $160,000 if merit filing jointly and $80,000 if the other filing statuses apply. Merit filing separate is not eligible for this adjustment deduction. Where is the deduction taken? And again, it's taken on the Schedule 1 line 20. For whom must the expense be paid? A student enrolled in an eligible education institution who is either you, your spouse, or your dependent from whom you claimed as an exemption. What tuition and fees are deductible? Only the tuitions and fees required for enrollment or attendance at an eligible post-secondary educational institution, but it cannot include your personal living expenses, such as room and board or other personal living or family expenses. This information is found in publication 4012 in the extension section, extension 6. Now, in addition to tuition and fees, other options are the American Opportunity Credit or the Lifetime Learning Credit. And we'll be discussing these a little later, but we want the taxpayer to take what is most advantageous to them. Okay, again, if you have any questions, please go ahead and put them in the chat. We have a poll question for you, and it is: Stan, an unmarried college student working part-time, earned $4,500 during the tax year. What is the maximum he can contribute to an IRA? So we want to give you a few minutes to research your course material so that you will be able to correctly answer this question. Okay, if you chose answer C, $4,500, then you are correct. Now, the reason he is limited to the $4,500 rather than the $6,000 because he is under 50 is it is the lesser of the actual contribution up to the limit or compensation, and his compensation was only $4,500. So that's why he's only able to deduct that amount. Okay?